In a recent video I released on my channel, I talked about executing a buy to close strategy for a covered call option contract that was coming due on expiration. By executing the buy to close, I was able to buy my contract back and retain ownership of my shares. In that video, the security under contract was an ETF with symbol ETHA. Well, now with the security released and available for me to trade, I decided to use it again to write another covered call. Think of it like a simple wash, rinse, and repeat. I'm able to continue to generate income by selling covered call contracts and collecting premium for each time I sell the contract. And as long as my shares aren't assigned on or before the expiration date, I keep those shares and I use them again over and over again. So I'm collecting premium by selling the same shares over and over. The security I'm trading has the symbol ETHA, which is the iShares Ethereum Trust ETF, or Exchange Traded Fund. So this ETF gives me exposure to the cryptocurrency known as Ethereum, or ETH, without having me to directly own Ethereum itself. So I minimize my risk, but I still get exposure to Ethereum, which is the second largest cryptocurrency in the market by capitalization. Before I show you the details behind this trade, such as the profitability and what I can expect from potential profit, let me just take a moment and mention my stock trader community. It's over at school.com/simpleoptiontrading.com. Here I host a free community for stock option traders like you and I, so we can trade tips, tricks, hints, and secrets about our current and future options trade. This is a great community for option traders to share information and help each other so that we can not only become better traders, but profitable along the way. In addition to the user community where members are encouraged to share information by posting, I've also included a classroom where you get access to courses and tools, such as my beginner covered call checklist, my cash secure put checklist, and my covered call mini course. So be sure to join my free community at school.com/simpleoptiontrading. I'm going to leave a link in the description down below. Well, now let's take a look to see if this trade actually makes sense from a profitability standpoint. So here we are using my covered call analyzer, and today's August the 4th, and we're talking about trading symbol ETHA. Now my cost basis for this is $27.69, and I have exactly 100 shares, so that will allow me to sell one option contract. Now the expiration date I'm looking at is August the 8th, which would make the length of this option contract 5 days. I'm looking at selecting the $28 strike price, so we'll go ahead and put that in. And for the option premium, I would need about 68 cents per share. So my total investment, my cost for the 100 shares is $2,769. Now, if the buyer of the option contract decides to exercise this option contract, they'll pay me $28 per share for my entire 100 shares, and I'll make a profit from the price appreciation of $31, and that's only 1.12%, so it's not a lot. And then for selling the option contract and having that contract get filled, I'll receive a premium payment of $68. So that's the 68 cents per share premium times the 100 shares. And that represents a profit of 2.46%. Now, in the event that my shares do get taken away from me on or before the expiration date, I'll receive a total payment, all told, of $99. So that's the $68 for selling the option contract, and then $31 in profit from the price appreciation. And that represents a 3.5% profit in just 5 days. So based off of these numbers, I think this option trade makes sense. Even if the option contract expires worthless and I keep my shares, I'll still collect the $68 in premium and have a profitability of just under 2.5%. So we finished up with the covered call analyzer, and we see that this trade makes sense from a profitability standpoint. So let's go ahead and walk through the steps to actually submit the order. So I've got the trading platform opened up on my smartphone, and you can see here it's for symbol ETHA. So I'm going to press trade and then trade options. And now I've selected the August 8th expiration date, and we're going to be using the $28 strike price. So from here we can see the details behind this actual option contract. It's got a delta of 0.46, which is really high. So I'm fully expecting that this option contract will get exercised and my shares will get taken away, and that's totally fine. That's actually kind of what I'm looking for. So I've purposely selected this strike price. As you can see, there's plenty of open interest, 5,848, and the current bid ask spread is 4 cents. So I'm going to be asking for that 68 cents. So I'm going to specify one option contract because I have 100 shares. And then for the limit price, I'm going to select 68 cents per share as the premium. And here you can see I'm agreeing to sell 100 shares of ETHA at $28 per share. That's my strike price on or before August 8th, which is the expiration date. So I'm going to go ahead and submit the order, and we can see that the order gets sent and received. And so now this order is placed, and we just have to wait for the order to get filled. So really good news. It only took a short while for this option contract to get filled. Here you can see I'm selling symbol ETHA with a $28 strikes price. This is a covered call with an expiration date of August the 8th. Now I submitted that order on August the 4th at 9:31 a.m. And you can see here it got filled that same day at 9:41. So about 10 minutes and this order got filled. And when it got filled, I received my 68 cents per share as the premium payment, which gave me a total of $68. So for this one trade, I just created an income of $68 for a 4-day trade. Now, as a new or beginning trader, you could do something like this just as easily. And as you gain more experience, skills, and ability to trade, you'll soon be doing trades like this, but instead of one contract, you might do 10. And so if you extrapolate that out, those 10 contracts at $68 per contract means if you sold all 10 contracts, you'd receive $680 for selling 10 option contracts that have a 4-day expiration. But just remember, scaling up to big trades like that doesn't happen overnight. We've got a lot more training and experience and practice to get through, because as new and beginning traders, we have to do baby steps first before we start scaling up. And not every trade is going to be like this. But if you pick a good underlying fundamental security, such as a stock or ETF that's trading well, and you carefully select an option, paying attention to the strike price, expiration date, and premium payment, along with the underlying delta and open interest, then there's no reason why you can't get there after gaining more experience and practice. This covered call option trade was a little bit different, so I wanted to take a moment and explain why. As you recall, the delta value for the option that I picked was around 0.46, which is pretty high. Normally, when selling a covered call, we'll look for a delta that's 0.3 or lower. But in this particular case, I purposely picked the high delta value, knowing that with such a high value, that the likelihood of my shares getting assigned and taken away from me, it's about a 50-50 chance. Now this particular ETF has been trading well, so I'm anticipating that the stock price will go up, break through my strike price, and so my shares will get assigned. But as I mentioned earlier, I'm okay with that. I'm actually trying to sell these shares as part of this covered call trade, and I want to free up the cash so I can put it to work in some other areas. So that's another key strategic trade that I'm making that you could learn from. Now, I may be happy owning the shares and selling covered calls over and over again, but if I see some other opportunities and I need to free up some cash, this is one way to do it. Well, I hope this video was helpful and you got to see how I submitted a covered call for shares of stock that I currently own, and I purposely picked a high delta value even though it raises the probability that the option contract will get exercised and my shares will get assigned, which is exactly what I wanted. See, strategically, I'm okay selling these shares because I want to take the cash that I receive for selling those shares and deploying it in a different trade where I think I can get a better return on my money. And so now is a good time to mention that if you really enjoyed this information and want to get access to more tips, tricks, hints, and secrets about options trading, be sure to join my free community at school.com/simpleoptiontrading. I'll leave a link in the description down below. I hope to see you over there, and I hope I get to see you in my next video.